Welcome back, folks. Today we're going to be talking about the breaker checklist. So this is a checklist that I use to essentially grade all my trades before I get into them, so I can understand the probabilities that they have to win, what I should be targeting as well for standard deviations and so on. I've mentioned it briefly on the last couple of videos, but we're going to touch on it a little bit more and include some other extra rules like look back period and so on, like how long is a setup valid for, and when should I avoid the setup after it's done X or Y thing. So the breaker checklist is really 4 main things that I am looking for the A+ setup breaker. So the A+ setup is going to be the breaker has an IFVG, the breaker has an FVG, the breaker closes on the first time he tries to close, and the breaker is an outside candle, meaning it is not between 2 other candles, and it happens to be in the middle. I'll explain that later. All right, awesome. So these are the 4 elements here that we're going to be using to grade all of our breakers. So going from the IFVG, an IFVG is just an inverse fair value gap. If you don't know what a fair value gap is, you can look it up on YouTube. I also made a quick video about it. You can go and check that out. But basically, it's just a pattern formation between 3 candles, where this is candle 1, 2, 3, and between candle 1 and 3, there's just a gap where these candles don't overlap with each other, and that is called the fair value gap. Okay, so the fair value gap, if you inverse it, meaning price comes and let's say this was a bullish fair value gap, and then price closes below it with the next candle like so, then that would make this an inverse fair value gap now, because instead of it being a bullish gap, it becomes a bearish gap with the right context. Of course, that's not always the case, but with the right context is an inverse fair value gap. So we're looking for our formation to have an inverse fair value gap like so. So we have swing low, high, low, higher, high, lower, low. In between this low to this high, we get the fair value gap originally that then gets closed below, becomes an inverse fair value gap. And now this top candle here with, again, is a 3 candle formation. So we got candle 1, 2, 3 to the downside, now creates a fair value gap here. So original becomes an IFVG, and then this secondary becomes an FVG. So now we have 2 PD arrays stacking on top of each other, supporting our trade idea. We then get a close below on the first try. So here on the swing low, we close on the first time we try to do it, giving us the close on the first time we try. There's no wicking or anything like that. It just comes straight closes. And then the outside breaker candle just means that from this swing high to the swing low of the breaker, we want our breaker candle to either be here, the very swing low one, or here, the very top one here. But we don't want our breaker candle to be, let's say, here. So let's say this was a red candle here. This is a blue candle. This is a blue candle. That would make this an inside candle. Inside candles, typically speaking, just give you a slightly less favorable odds. So what we want to see is just it being here or here. Now I'm going to show you guys some actual live examples so you get an idea of what the perfect breaker looks like, and then I'll explain how we utilize it. All right, awesome. So starting off with the 5-minute, we have a high, low, higher, high, lower, low, higher, high, making these changes to the delivery to the upside. And then we have a swing high, low, high, giving us our sweepable. We then go and sweep that. So let's drop onto the 1-minute time frame. On the 1-minute time frame, we can see that we have, of course, an IFVG right here. From this wick down to this wick, it gives us the IFVG formation if we close above it. So that would be our starting point. So IFVG question mark. Yes, we have it. Then do we have a BISI? Yes, we do. The BISI is not drawn from wick to wick in this case, because as you can see from this candle to this candle, there's a really small volume imbalance between the two. We want to include that volume imbalance into our fair value gap. Here, we didn't have any volume imbalance. here we do. So you want to include that. And that means that we have an FVG now. Okay, awesome. So 2 out of the 4 things we need. We then look at the top, right? Low, high, lower low, higher high. Did we close on the first try we tried to do it? Yes, we did. This candle confirms the breaker because this is the swing high. That would confirm the change in set of delivery. So did we confirm that? Yes, we did. And so this candle, this blue candle, is our breaker block or cyan, depending on your screen. Some people were telling me that their screen looks green. It's cyan, so it might be blue or green. But this up candle is our breaker block. And is our breaker block between multiple candles? No. Our breaker block, as we can see, is the very swing high of the formation. Therefore, it's an outside breaker. So awesome. We have IFVG, FVG, outside breaker, and we closed on the first time. That gives us 4 out of 4 things we're looking for. And so automatically, when I see this, it makes me believe that the actual target will be 4 standard deviations on the trade. Now, obviously, context is always needed. So where are we currently? What time is it? How much more of the day is left? If this trade shows up at 2 o'clock in the afternoon, 3 o'clock in the afternoon, if it's small enough, we might make it there at before the end of the day. But if it's a little bit big, we'll deliver to 2 standard deviations, typically speaking, before the end of the day. And then as soon as the market opens on Asia, it will quickly shoot up and finish the standard deviations for that trade. So yeah, let's hit the replay. We'll let it do its thing. This is the low over here. And this is 4 o'clock. So market is almost close. Market is getting ready to close here. As you can see, we gap up and then we hit 4 standard deviations eventually during Asia. All right, there it goes. So we hit 4 standard deviations right around midnight, give or take. As you can see, if we drag out the 4 standard deviation line, that gives us the high. And then we'll go to the 5-minute and we'll make note of something else, which is the pullback. So after it hits 4 standard deviations, we can then see it obviously reverses, comes all the way back down, and then we go all the way back up and continue doing its thing. So these standard deviations are what we're going to be using for our targeting, and that will tell us whether we should be expecting a continuation, and after that continuation is done, if we should be expecting a reversal or a pullback and so on. Typically speaking, when we hit 4 standard deviations from a high probability breaker like so, we will see at the very least a retracement onto the 2.5, like so, or we'll get a full retracement onto the OG, and then from the OG breaker, meaning from the original entry here, we then can see price 1 and 2 continue after that, and it will basically create what I call a play from a play. So it's just a brand new play forming out of a play that has already delivered. And so you don't want to take that play blindly, meaning when price comes back down, you're not buying this blindly here. You're waiting for a play from a play to come out of it. Once that play from a play forms, then you can take action because he basically double confirms to you, hey, we actually don't want to take this low yet. We want to continue going that way. And it will show you, that he wants to do so. So let's go over an A type of setup and what that looks like. All right, so zooming in into the same area that we were breaking down over here, this would be bullet number 2. Bullet number 1 was here. I made a review about price action for this day already, so you can go and watch that. It was April 25th. It was uploaded on Friday. So this is bullet number 2, and on this setup, we can see that we have an IFVG forming here. We have FVG forming here. Our breaker block confirms whenever this gets closed on above, which is the swing high. So low, high, lower, low, higher, high. And as we can see, price failed to confirm on the first try. So he tried to form above it. It wigged, closed inside. Next candle tries to form above it. It wicks, close inside. Next candle opens up above it. So it opens up here and it closes above it. This does not count as a confirmation. Okay. The red candle opening above and closing above does not count. You need an actual close above because it opens and it ends up bullish. So this is the actual confirmation candle right at 907. So we have the IFVG, we have the FVG, we have the breaker block being this blue candle, this up candle, being outside, meaning it's the highest high of the formation of the swing. So it gives us 3 out of 4. The only thing that's lacking is the fact that we didn't close on the first time. There's one more criteria that I use whenever it doesn't close on the first time, and that is going to be the fib tool. So if you grab the fib tool like so, or the, I think it's called Gannon box or something like that, you put it at 0, 25, 50, 75, and 1. This will grade the retracement. So here, when it failed to close on the first time, it didn't retrace 25% or below. Here, it didn't either. And so none of the retracements were 25 or below. Typically speaking, we don't want to see any retracements that touch the 25 line or below. Definitely, we don't want to see 50%. Now, it doesn't mean that those setups will fail every single time, but for the most part, they will tend to fail slightly more than the other setups. And if your grading on everything else is poor, these setups will definitely not go very far. They will form, they will expand a little bit to maybe 1.5 standard deviations, but really not much further than that for the most part whenever they retrace very deeply. So that's what we want to put. This would be a setup. And on A setups, we want to be targeting 4 standard deviations as our standard as well. Now, this setup is also the second bullet. Second bullets, typically speaking, are the best trades to take. Now, it doesn't mean you don't want to take bullet number 1. You do want to take bullet number 1, of course. But if bullet number 1 fails, bullet number 2 is the last line of defense for this idea to be correct. So if it fails, you're either on the wrong side or it's going to take a lot more tries before it actually goes the expected way, which means that you don't want to be involved in that move. Second bullet, for the most part, tends to be 4 standard deviations for most moves, as long as you're obviously with the current market, current trend in the market conditions and so on. But we can obviously see that this setup on Friday happened here. It confirmed right at 907, and we hit 4 standard deviations here a couple hours later. So that is an A setup. Let's go over B plus. All right, so continuing next to the same setup, we have CISD, high, low, high here, giving us the 5-minute sweepable. Let's go on to the 1 minute in the same area. And we're looking for the first 1-minute breaker after the sweep, which would be here. Now, this 1-minute breaker has FVG, right? You see, we close on the first time by a hair, but we do close on the first time. So that's 2 out of the 4. We do not have an IFVG, and the breaker candle is not an outside candle. It's an inside candle. So from this swing low to this swing high, the bullish candle is between the 2 candles. So it's not the edge or the bottom, is right in the middle. That's what I would call an inside candle. So typically speaking, this setup is more likely to just go to 2 standard deviations to 4 standard deviations. B plus can be here or here. It can do one or the other. So this is where context is very important. And also what has happened before will tell you the rough estimate of where this is actually going to go. So if you have the context that the previous setup is going to be expanding further, then you want to be capitalizing on that fact and you want to be using the higher target. If you do not have the context of anything prior that's very high probability to go further, giving you the 4, then you want to go ahead and stop at 2 and just be safe rather than trying to overshoot and, get chopped up after the fact. So the context here, at first glance, it would seem like this would be the stopping point because this already met 4 standard deviations. 4 standard deviations would line up with the 2. So that would be the context if you're just looking from the 1 minute perspective. I'm going to teach this on a future video, but the actual target for this trade is based on the 5 minute time frame. So based on the 5 minute time frame and the 15-minute time frame, this is the actual fib we're following for the rest of the day. And this is the target that we're hunting for end of day. Now, we might not get that today, but at the very least, that's what we're going for. If we're going for this, our stop is relatively close to the low of that, giving us the context that if this fails, this is likely going to fail. So if this fails, this idea is dead anyways. So we're following this projection, expecting it to deliver, which means that automatically our projection here is going to deliver, not because our projection is strong, but because it's piggybacking off the fact that this projection is strong. So we go for 4 standard deviations here. That means automatically we get 4 standard deviations on the asset that we want. And yeah, we did touch that. We didn't get quite a 4 standard deviations from the other projection, but we got just shy of it by the end of the day. So that is a B+. And let's go on to the last one, which is going to be B. All right, so backing up onto today, on the early session when we were in London, we have a CISD, we have a sweepable, so low, high, low, giving us our sweepable. So let's drop onto the 1 minute and see what that breaker look like. Breaker has no IFVG, so -1 point, no CB, -2 points. We then have a wick, and then it retraces, -3 points. So it's automatically going to be a B rating. It also retraces back to 0.25, which is okay. 0.5 is where it becomes a pretty risky trade. But 0.25 already puts me aware that, hey, this could get stopped out, and then I would have to use one more bullet. So it's just something to keep in mind so you're aware of it. You're not caught by surprise, and you're not wondering why your setup failed. So 3 out of the 4 so far are a no-go. It does have the lowest candle being the red candle as our breaker block. So that is 1 point going for it. And so this, typically speaking, again, the target is going to be 2 standard deviations because of the way that it formed. So this typically would be my TP. Now, again, context is very important. What around the trade would make this be a higher probability to go lower? Yes, you can target 4 standard deviations in these trades, but the context is necessary. Without the context, just cut it off at 2 standard deviations always. If you're fairly new, just always cut it at 2 standard deviations and just watch, learn, see what you could have done better on the setup. So let's see what the context was. The context on this trade is that this is actually a breaker already here on the 5 minute. This breaker creates this sweepable. This sweepable then creates a play here. And this play creates then another change set of delivery, another sweepable. We then sweep, and then our play comes out of that. So we have to evaluate this play first and see where this play was going. This play has a valid CB on the 5 minute model, which is what I taught on Friday, meaning when price comes back, taps this high. This high is actually a play from candle 1 of this. We're going to want to do the projections from the breaker of the 5 minute. And what's the grading on the breaker on the 5? IFVG? Yes. FVG? Yes. Outside candle? Yes. Closing the first time? Yes. It's a 4 out of 4. This is an A+ to likely go to 4 standard deviations. So because of that, we're going to be targeting at the very least 2 standard deviations of that. I don't target 4 standard deviations of 5 minute breakers almost ever, by the way. It's just usually a really big target for the most part to go for, unless we're talking about New York or you have high volatility. So for example, this one here, it was a 5 minute and it was a 15 minute, and it has the context of the hourly. So there's a 1 hour sweep that was very important for this to actually be valid. Here, we don't have anything to the left to validate this trade on the higher time frame to actually make it go down to 4 standard deviations, but at the very least, it will go to 2. So with that context in mind, zoom back in, we can also go and look at the 1 minute trade that came before that. So the 1 minute trade will tell us also those projections. And you go, okay, cool. Is this likely going to continue down lower than this? If you come to the conclusion that it's not, then just cut off your trade at 2 standard deviations, walk away, let it shake out. If you think, based on the extra context, it can go further, you can target more. But you need to understand that if it goes to 2, 2.5, and it comes back and stops you out, then it's something that you're willing to be okay with. And that's what a lot of traders need to come to terms with. You need to be able to make decisions based on data and say, am I okay with this trade that tells me that very often it only goes to 2 standard deviations? Am I okay with holding it for longer and risking the fact that it goes against me? If the answer is yes, then you do it. If the answer is no, then you just cut it off at 2 standard deviations and walk away happy, and you learn. You take down, okay, what made it go further? What are the clues that maybe I could have had to hold this trade for longer? And then that tells you what you should be doing. So that is pretty much it for the grading. Let's bring it back. 4 elements, A+, 3 elements, A, 2, B+, and then 1 or none, it's just B. 4 standard deviations for these 2 always, 2 standard deviations for these 2 most of the time. For the B+, more often, you can go to 4 standard deviations because the context will be easier to tell. But for the B, for the most part, I'm usually cutting this off at 2 standard deviations, unless I have a very strong reason why the trade really should be going further than that. But for the most part, I just cut this off at 2 standard deviations myself at the moment. The look back period, I forgot to mention that. All right, let's go over the look back period. Look back period is super fast. Look back period is just how long a setup is valid for and how long that entry. It's something that I would use multiple times. So the look back period on the 5-minute time frame is going to be 2 days maximum, meaning the day of and the next day. So if today is the 24th of April and this setup, let's say, formed in London of the 24th of April, I can utilize that breaker and that sweepable from Thursday still on Friday the next day. Now, preferably, you do have the sweepables and breakers fresh from the day of, but you do need to be utilizing the previous day in terms of context, because a lot of times it will tell you the story. Again, everything is only up to 2 bullets. So bullet number 1 and 2. After that, I pretty much toss it out the door. But yeah, look back period is going to be 2 days. As far as the 1 minute goes, look back period for the 1 minute breaker portion of it is only going to be 1 day. And preferably, it's going to be within only 2 sessions. So if this breaker formed in London, for example, then pretty much that you're going to want to use it only up until New York. If you formed in Asia, you're only going to want to be using it up until New York. But if you formed like in Asia and now it's New York PM, for the most part, that breaker is going to be relevant to the PM session of that day. It's not always going to be the case, but for the most part, it is. So, if an order has already reached too far away on the 1 minute, and I don't mean too far away in terms of distance, but I mean too far away in terms of time, then for the most part, I just ignore that breaker unless it does a play from a play. We'll be explaining plays from plays. We'll be explaining plays from plays on a separate video. It's a very simple concept. It just means that instead of entering the first time, you just wait for a new play to happen, and then that's when you actually trigger the order. But yeah, thank you for watching. Like, subscribe. Please give me some feedback on the videos, on what you're understanding, what you're liking, what you're not liking, what I can improve on, and so on, so we can make the series better. I will be talking about um, the play from plays as well as a couple other things in the next video. But the 5-minute model version, it's pretty much almost fully laid out. Now it's going to come down to just experience. So I'm planning to do some live sessions, obviously, with the actual trading, and then maybe some FX replay if people are interested in that. I don't use FX replay the way I used to before, but if people are interested in that, I can do some FX replays just to kind of showcase what that looked like and how you can improve a lot faster by utilizing